I try to look for transition points. In other words, I look for the incremental change. And my example would be is that if a company is hugely successful and earning great returns on equity, on great margins in their business, you have to make the assumption that they can sustain those margins in order for their valuation to stay high. And at the same token, if you don't believe that, by the way, that company you should not be part of your portfolio. So I look at incremental rates of return. I like to own companies whose incremental rates of return are improving, and I like to sell and or short companies where incremental rates of return have peaked. And I used the example before that, I've been very successful in the industrial commodity companies because the key to there is to look at the capital spending in the industry. And typically, companies get most euphoric, same in the stock market, when things are topping. And so when the cycles are topping, they're accelerating the capital spending the most. That is the precursor for a top. The same thing occurs at the bottom. At the bottom, they get so scared that they think the next day they maybe not going to be able to open the factory. They cut all spending to the bone. That is the bottom. I used an example this past week in what I wrote, that we have had the longest stretch of basically reduction in mutual funds. In other words, there have been outflows for the longest period since 2004 over the last 4 months. And my example was that is not typically basically the gong for a top in the market. That normally tells you you're near a bottom rather than a top. So the point of my piece was then the probability of next leg is up, not down, because everyone is bearish. And if everyone is bearish, who's left to sell?